Is 2022 the year that Netflix, NFLX, finally blinks? If I told you that a particular stock had a 10-year annualized total return of 36.7% through February 8, you'd immediately want to know its name. However, if I told you I was talking about Netflix, your demeanor and interest would likely take a 180-degree turn for the worse. The conventional wisdom is that Netflix's growth story is shot. It can't add US subscribers at nearly the pace it once did, and its international growth isn't nearly as profitable for the company. Netflix appears to have lost its groove. So how does it get it back? I've got an unoriginal idea involving its content. But first, let's consider its current financial health. Netflix stock is a lot cheaper today. In 10 weeks, NFLX went from trading at almost $700 to a 52-week low of $351.46 on January 26. It has since rebounded over $400 as I write this. On January 20, the company delivered its Q4 2021 results. Revenues were $7.71 billion, 16% higher than a year ago. Its operating income for the quarter was $632 million, 8.2% up from Q4 2020. If you take them on their own, the numbers were perfectly respectable. However, when your shareholders are used to outrageously good, perfectly respectable doesn't cut it. Its shares tumbled on the news. The problem wasn't necessarily its performance during the fourth quarter, although its net addition of 8.28 million subscribers did come in 20,000 short of analyst expectations. The problem was instead the enormous gap between the company's Q1 2022 forecast for net subscriber additions and analyst consensus. How big a gap? Netflix expects 2.5 million net additions. Analysts expected 7.25 million, almost threefold more. What's important, though, is what this means to overall revenue. In the fourth quarter, Netflix's average revenue per membership, ARM, was $14.68 in its US and Canada, UCAN, region, Netflix's so-called bread and butter. As a result, investors might be tempted to assume that the 10-cent sequential increase in ARM in Q4 2021 is a sign of a tremendous slowdown. Perhaps. Or, it might just mean that people took advantage of a milder COVID-19 in the final quarter of the year, opting to get out more and stay in less. The UCAN region generated $14.25 in ARM in Q1 2021. If Q1 2022 ARM in the UCAN region increases by half the year-over-year increase of 9% in Q1 2021, it will amount to $14.89 in the quarter ended March 31, 2022. Multiply this by 4.75 million net additions, 7.25 million analyst estimate less company projection of 2.5 million, and we're talking about a $70.7 million shortfall. That's not a lot for a company that generates more than $7 billion in revenue per quarter. The more problematic figure is operating income. In Q4 2021, its operating margin was 8.2%, 620 basis points less than Q4 2020. On the bright side, Netflix forecasts Q1 2022 operating income of $1.77 billion and an operating margin of 22.3%, 790 basis points higher than a year earlier. The business remains very healthy from where I sit, yet it trades at 50% off its November highs. I don't see why it can't keep its share price moving higher by adding a key revenue stream. Monetize its impressions. As I said in the intro, the idea to monetize its free content isn't original. I got the idea from Simon Owens, a Virginia-based media journalist and consultant. Owens points out that the company's main Facebook and YouTube accounts have 107 million subscribers. Add in some other sites, and it adds up to 153 million. So if Netflix ran programmatic ads on those channels, Owens estimates it would add millions in revenue with virtually zero cost to the company. If it moved beyond its social media video channels to its podcasts and text websites promoting its streaming content, this would add to its newfound revenues. It's pretty incredible when you think about it. Netflix not only built the world's most successful subscription product, but its free content has a larger audience than the vast majority of web publishers on the planet, Owens wrote on February 8. And yet its web content production resides entirely within the marketing department. It is, in my opinion, an under-leveraged asset that could significantly boost Netflix's bottom line. He finished his thought by suggesting that if Netflix were to hire an actual sales team to develop its ad business, it probably could generate significant revenues without continually raising prices. Or, heaven forbid, introduce a lower-tiered ad-based membership. It's not an idea that I've ever considered. In fairness, I'm a technology novice, but the argument for doing so has merit. The bottom line on getting its groove back. I've followed Netflix's rise for several years. I've always found CEO Reed Hastings and the rest of the management team seemingly able to rise above any challenges they faced. The biggest challenge is arguably the increased competition Netflix faces. However, it addresses this issue head-on in its Q4 2021 shareholder letter, suggesting that the market for streaming in its UCAN region has barely scratched the surface. So, while many are writing the company's obituary, the reality is that the proper execution of Netflix management's business strategy will be more than enough to deliver future growth. While the company's share price suggests it's lost its groove, I don't think that's the case. Instead, investors have become far more conservative about the valuation multiples they give growth companies such as Netflix. That might last a few quarters or even years. Ultimately, however, investors should consider Netflix's long-term potential when thinking about what to add to their portfolio.